Perfect. Thank you, Celine.
Great. So first of all, thank you for organizing, because it's organized by Fintech and BMI. And as we are with a small group, I would say, or you take the mic and you ask a question at any time, so you can interrupt me, or you put it on the chat. The chat is open as well, so I will try to take the question. I don't know all of you the level of VC, so if I speak too fast, if it's too difficult or too technical, just shout and stop me. Okay, we agree on that? So what I want to do is to look to the world through the eyes of a VC, because that's the best way. If you understand how a VC works, it's the best way to know how to seduce the VC. You see, if you understand why he is doing something or she is doing something. Unfortunately, in 89% of the cases, it's a he, not a she. That's another topic, of course. But let's look how it works. So first of all, if you go to VC, how much chance do you have to make it in that world? That's what you call the venture capital funnel. Funnel means you start from a number of projects. In my example, we took 1,027 projects, and then they go to the different stages. And you see that each round, first round, second round, third round, fourth round, at the end, at the sixth round, there's in fact there are 9 left. So you see, it's for the happy few to go through the whole day. This is not to discourage you, but to say we should be careful, and you should be careful at every moment to say we want to get there. So, and what it means to get there, it means that you go down the whole way, and just to have some concepts which are quite logic for most. So you have the incubation. Most of the startups, they don't go to incubation, and they already go the next step. And after incubation, so if you get to what one, you have, if you see the incubation, there's a lot of money in the market. There are grants, there's a public incubation centers, that works. And then once we start, and now in the third column, you see the end of incubation. Then you have the first problems, and you see there you have the value of debt. And the value of debt starts at the end of the incubation. You have the first round, where you have the angel investments. Then you have the seed investments, the early start investments. And you see, at each of them, it's dangerous. And it's at the end of the road where you see things goes up again, there's the value of debt over. So in fact, the biggest problem for a company, for a starter, is that part. From once the incubation is over, no more access to different grants, and then you have to find each time for each round somebody who's helping you to finance. Is it okay if it's too fast? Let me know, or put on the chat if you have more questions on that. So this is a bit the basic concept of financing, that you have to go to different rounds. You don't have to go to all of them. And some may say, no, we don't work with the business angel, we start with the seed capital, or we start with friends and fools. But that's in fact what in most cases happens the whole way you should do. Now, if a VC goes, what the VC normally says when he stops, put money in a company, he says, how much do I want? And there, of course, we have a lot of calculations, so don't be afraid. But what normally the investors say, he says, I want X time my money back. So if I'm an investor, I will say I put 100,000 in a startup. If my multiplier, as we call it, is 10, it means I want 1 million at the end of the road. So that's what you call the multiplier. And you see, for instance, if I look to Serie A is the very beginning, it's a startup. There you have a multiplier from 10. It means I invest €1, I hope that €10 comes out. And that's in fact how they talk amongst VCs. What's your multiplier? I want a startup from 7 onwards, I'm interested. That's in fact the way they work. Now, if you would like to translate this into what we know as a return, for instance, I take Serie B. You see Serie B. There is here a return of 6. Well, if I would say a return of 6, then I can look at my table at the left. A return of 6, it's 6 times. So I take the line of 6 times, which is the 5th line of my thing. And if the 5th line, 6th line, if my exit is in 6 years' time, this corresponds to a return of 35%. You see? As an entrepreneur, you're looking at a return of 35%. The VC will say, I want a multiple of 6 after 6 years. That's exactly the same, but in fact, a different language in which we speak. Is it okay? I'm too technical for somebody? Please.
So it means you have to have a return of 35% per year in order to reach the the return of 6 after 6 years.
Indeed, it means if you have a return of 35% a year during 6 years, then your amount is multiple 6. I put 100. Each year I have a return of 35%. So the first year 100 becomes 135. The second year it's 135 times 135. It's composed and so on. This means that at the end of 6 years, I have my multiple of 6, you see. And so what the venture capital will say, not to you, but amongst them, I want to invest in his startup if I have a multiple of 6. This means that you must show in your business plan that you have a return on investments of 35%. It's clear? Okay, so now of course you could say, but this is 35%. This is screwing. This nobody does that. Yeah, but this is based on business plans. We know that a business plan is never realized, and there's a big difference between the return you want, desired return, and the return that you realize. You see, but what is important is for you that you know to speak another language but understand each other. He speaks or she speaks in multiples, you speak in percentage. And then, of course, you can make the link between both. You see this just to illustrate, we'll not go in detail today. You see and illustrate the difference between the multiple and the percentage. So if I take the example, which is on the bottom right, 12% during 10 years equals a multiple of 3.1. See? And that's in fact how you should see. This is just to introduce you on that. Now, how much do they want in reality? And how much do you have to show in your business plan? Well, it depends on what phase you are. If you are, for instance, let's say seed, the yellow one. Seed means the highest risk is already over, but still you are part of the value of debt. You are still in high risk. High risk means high return. So if I take the seed that the amount is between 250,000 and 5 million, the average exit happens between 6 to 7 years. There the return is 60% or even more. And as I just showed you, this 60%, 6 years, corresponds to a multiple of 10. So a seed fund, because each fund has its own specialty, a seed fund says, I want to select those startups where €1 becomes €10 after 6 years. So if you want to attract an investor, that's what you have to show in your business plan, that indeed, after 6 years, there's a multiple 10. That's in fact how it works. Now, if you look, the farther you get from angel to seed to growth, you see that the return expectations, the third line, becomes lower. You see at the same time that the multiple becomes much, much lower. Does somebody know why the multiple decreases much more than the return desired? I will repeat my question just to limit you think. You see that return expectations 75, 60, 40, 25. But then if I look to the multiple, it goes from 15 to 10 to 7 to 5. It decreases much faster. Has somebody idea why?
Because in the exponential thing, I would say, with the returns, with the returns.
Yes, Johan, you're right. It's the exponential thing. And the second thing is that the farther you get, the closer you get to the market. This means that your exit is closer. And as you can see, for instance, the angel, he stays between 8 and 10 years. The growth only between 5 and 7. So it's a lower return and the period is shorter. Both elements leads to smaller multiplier. Okay? Sorry to be a bit technical. Now, this is what they desire. This is what you should show in your business plan. Now, let's look at reality. We don't think about dreams anymore. We look what happens in the real world. And so in Europe, there has been a study looking at the different returns. And if you look, for instance, let's take by region. We take, for instance, the West region, the very first column. There you see that internal rate of return of the most recent closed fund. The first line, it's 12%. The average is 12%. So you see the big difference between what is desired, 70, 60, 40%, and what is realized. Of course, in what is realized, you make the very good investments, but at the same time, you make investments that go bankrupt, for instance, or investments that do not give a high return, what we call then the lame ducks. Altogether, you see that we are at 12%. At the same time, if you look to this figure, which has been analyzed by all venture capital funds in Europe, you see that, in fact, 12%, I go to the first column, the very first all, have an average of 13%, which is not very high. 13% is the average. Now, if I look to the risk, if I say the risk, for instance, you look what we have, maturity companies, maturity countries, high is 10%. This means, in fact, if you take a low maturity country, that you have much more return on average than a high maturity. If you invest in Romania, you could have 17%, in Belgium only 10%, because in Romania you still have more potential to grow, you see. But on average, this is not desired. This is what is the really return ex post of all venture capital funds, which is retain on average 12%, which is not enormously. And if you want to make more money, the only solution is, in fact, to go to countries, maturity, second column, where the maturity of the country is low, which are the emerging countries within Europe, of course, because it's Europe. So there you have to go to Eastern Europe to make money if you want. If you look to the column of stage, there you see something very interesting, namely that all stages, I think the bottom line is 13%. Early is 14%, late it's 11%. So 11, 14, it's a small difference, which is partly compensating the higher risk of seeds, you see. But so the conclusion is average return is 12%. We compare it to the desired return, which was 40, 50, 60, depending on the phase. And if you want to make money, you should go to early stage, where you have slightly big money, but higher risk, or you should go to some regions. Okay? Now, I told you to get money, you have to prove to the venture capitalists that he can make a lot of money, up to 40, 50%. So what you do, what most people do, they have a business plan which is too optimistic. Now we did another exercise, which I like very much. We compared the business plans which has been presented to the venture capitalists, and we compared them with the real realization at the level of the enterprises. So you see, this slide you see in front of you is the return at the level of the venture capital funds. Now I'm going to look at the return on the level of what you call the investees, meaning the companies in which the VCs have invested. And we compare the return proposed in the business plan at the moment that the business plan was introduced to the VC, and we compare it with what really happened at the level of that company. Do you see the difference between two exercises? Let's have a look. You can always put questions in the chat. Feel free, or you can take the mic, whatever you want for those who arrive now. So, and this is the big discrepancy between the forecasts and the realized financials. This is a not yet published study. And you see, for instance, if I look to the first part of my graph, then you see that what you see realized and what has been really done. So you see, for instance, the left line is the average revenue. So what you see there, if I look to the very, very first column, so you see it's a sample of 465 companies. This you see in the gray line on the bottom. We analyzed 46 companies, and they all said that, in fact, in the year of the campaign, means the year that they ask for venture capital, they say we're going to make revenues, turnover of 409,000. What they did in reality was 230. They said, and let me jump to the third year, they said on the third year on average, we're going to do a turnover of 7.8 million. This is the average turnover of 400 files, of 400 companies. The average turnover forecasted in the business plan. And what they did was 491. You see, a huge difference. Now, of course, if I look to this turnover and I try to translate it to profits, then you see the right part of my slides. We all said in the beginning, and you see again my sample of 470 companies, they all said we are going to make losses the first year. That's classic. But from the second year onwards, you see that in fact there were no losses, but you had profits equals 200,000. And in fact, what is the reality? The reality was 130 losses. If I look to the very last column, the very last one, the average profit that was forecasted in all this business plan was 4 million. The profit they realized was 150,000. So you see, there's a huge difference between what people forecast and what happens in reality. In other words, every business plan is completely wrong. Every business plan introduced to obtain venture capital is too optimistic and does not correspond with what afterwards happens. So is this cheating? No, this is because we are just by nature, I think, too optimistic to do it. By the way, very interesting as well. If you look at this discrepancy, files introduced by a man have much more discrepancy than women. So women are closer to reality than the man. Men are more optimistic, know how to seduce the VC. That's something important as well, but that's the gender issue we can discuss later on that. So to summarize, especially for those who like what I said until now, if you go to a VC, what you have to do is show there's a return. The VC is talking in terms of multiplier, not in terms of interest. So not in terms of return. You have to show it your business plan.
I'm so sorry. 1 second. Can you please, all the participants, can you make sure that you have your microphone off? Thank you. So sorry for that.
Thank you. Yeah, this is always like that with webinars, and it's normal. So this was the difficult part because I thought in the beginning you have a clear mind, so I could go to the difficult part. Now let's make it a bit more easy. Why do you need money? Why do you go to VC? Well, you go to the VC and the VC friends are scale-ups. I know that some people around the table have scale-ups. You see that in fact the blue and the orange, this is what is tangible. This is buildings or this is whatever. You see that most of the money is used for intangibles. Intangibles means business improvement, to the right side, training, software, R&D. It's not machinery, it's not land, it's not buildings. If you look to major firms, it's mainly tangible goods. So if you say, why does a scale-up don't go to the bank? Well, there are two reasons. The first reason is that you don't have payback capacity, as you have seen in the business plan. But the second one is that the banks don't have collateral because banks like to take mortgage or like to do leasing. They cannot because what you buy is, for instance, software, which is very hard to evaluate and very hard to take any guarantee. So in fact, what you see is that venture capital is used to finance intangibles. Intangibles cannot be financed by banks. On the other hand, we need intangibles because, now let me just make one macroeconomic consideration. You see that the growth in countries where the investment in intangibles is important is faster. So this graph, in fact, shows why venture capital is so important and why at the political level you should give preference to venture capital. Because venture capital means indeed that higher venture capital is better economic growth. So in fact, venture capital finances intangibles, intangibles leads to growth. You see that on the level of the firm and you see that on the level of a country as well. Good. If there are no questions, I see the chat is still empty. Let's move then to how a venture capital fund is working and who are the parties. No questions?
Yeah, yes, I have a question that maybe that's for Joanna. Since it's the first time I'm using this system for webinar, I don't see the chat actually. I don't see how to use the chat. I don't know if I'm the only one
So
with
normally the chat should appear on the right side. Somebody already wrote, join the conversation. Monica filled in, she put something. Do you see it?
Yeah.
Samuela, do you see?
No, I just see like at the bottom of my screen, the microphone, the camera, and screen
Can you
share option.
exit full screen, maybe?
Yeah. Yes.
You have session chat. Do you see it? You are on mute.
Yes, now, like leaving the full screen, I see the option for the chat.
Yes, that sometimes, yeah, perfect.
Okay.
Great, sorry. Thank you.
Sorry.
Okay. Great. This was a nice introduction, so we can start again. So,
sorry, Rudy.
Yes, Jean-Brel.
Does it mean we have to find VCs in the countries above the red line? They would be more compliant or more understandable?
Yeah, indeed. That should be the best way. And I think in those countries, it should be the best way to create economic growth, Because, So what is the philosophy? The philosophy is that if you have, for instance, if you take one country in Europe where intangible investments are higher than tangible investments, that's Germany. See? Because if you invest in intangible, you invest in software, you invest in innovation, you invest in the future. If you just do buildings, you don't create growth. Of course, you create growth, but you don't have the accelerator on growth. And so your analysis is completely right. So, in fact, if you would advise politicians to do, you should say in those countries, please fix on venture capital, because that can change the world, your world. Other questions? Is it clear?
Thanks.
Great. Can you confirm there's a shift from equity to more lending by VCs? Well, this is, of course, linked a bit to the interest rate. If the interest rate was very low, we see that, of course, you had a higher leverage, because if interest is low, you see that, in fact, even for the equity firms, they try to limit the amount they put. If you go to an equity firm and say, I have a financial needs of 1 million. Well, if they can say, we can leverage by having a debt 500, 600,000, then for them, that's a leverage on return, you see. And even in America, it's even more the case than we have with us. You see, for instance, in the United States, the venture capital fund as such is for 75% financed by debt, guaranteed by the government, by the way. It's a very subtle system. If somebody wants to know the ideas, I can just explain you. But indeed, as the interest is low, there's more debt financing, even with equity. Of course, you can in a company, you cannot have all debt finance. You need sufficient buffer in case something happens. So we always say that in a company, even in high tech, you see at least 1/3 should be equity. And then, of course, the second part is quasi-equity, something which is close to, but not yet equity. That's the second, like what you call mezzanine. I think some of you might have heard about that. That's the second part. And in fact, 1 and 2 should be 50% of your balance sheet. Okay, great. How does it work in the world of venture capital? Well, the problem is that 3 is a crowd. 3 is one too much. That's always a big problem. Why? Because if you compare, for instance, venture capital with business angel, a business angel, he or she is investing her money. A venture capital fund is managed by a general partner. The general partner normally is not the one having money. It's the one collecting money. If you collect money and you spend money from somebody else, it's completely different than if you spend your money. If you're in a restaurant, you see somebody drinking a very good glass of wine, mostly it's on the expense of the company. Exactly the same thing. So in that case, you have your venture capital fund. So the first phase venture capital fund, which raise money by what we call the limited partners. So in the jargon of the VCs, you speak about LPs and GPs. The GP is the one who is managing the fund. He or she is collecting money from LPs. LPs can be pension funds, insurance companies, private people, public people, banks, and so on. These are all limited partners. The general partner is managing the fund. Again, the general partner is not an investor, but he is managing the money from the LPs. Now, this person, which is the most visible one, if you speak about the fund, you always say, who is the manager of the fund? This is the one who has contact with you. So mostly if you go to venture capital fund, you don't see the limited partners, you see the general partners of somebody from his staff. Now, it's always important to see how is a general partner financed, because then you should know how to seduce him or her. The general partner has two ways of financing. The first one is a slump, an amount to manage to have this office, the secretary, the car, and so on, which you call the management fee, which is between 1% and 3%. That's classic. But the second one, and that's the real concept of venture capital, well, what does he do? He goes in the first phase to the investors, to the limited partners. He says to limited partners, invest in my fund, I will have a return of so much. In that return, the first thing you have is a hurdle rate, meaning I'm surely going to have at least 8%. That's for you guys, for LPs. If I do better than that, if instead of 8%, I release 12%, you have seen 12% was the average of the VCs in Europe. If I realize 12%, on the 4% supplementary, a part should go to me. To me, who is not an investor, but who's just managing the fund, because I selected the nice projects. So in my example, return is 12. 8 goes to the limited partners. Out of the 4, 20%, being 0.8, goes to the general partner. And this is what you call the carried interest. This means that the general partner has all interest to go to big companies who have a high level of return. So the general partner is not interested in investing in a company that has only 10% return, because then there's nothing in for him or for her. You see, this comes back to my slide. They want 40, 50, 60%, because if you can do it, you have a carried interest. So first partner, the general partner who is managing the fund. Second, the limited partners who are putting money. And then the third party is in fact the companies, the startups, the scale-ups who are looking for money. And because you have those three partners, you have what academics call the agency problem. It's like you have, for instance, a company, and the company is managed by somebody who's not an owner, somebody who's not from the family in a family company. That gives conflicts. That's what you call agency problem. And to motivate the agent to do a good job, you have the carried interest. That's in fact how it works. Now, why is it important for you to understand the carried interest? Because if you negotiate, the first thing you should know in front of me is that a limited partner or a general partner. If it's a general partner, that person will look to see, have I carried interest on this file? If not, he will not be interested or she will not be interested to invest. So that's why it's important to know the functioning of the VC. That's really the core business of VC. Does somebody has questions on that? No? You can take the mic or you can chat, whatever you prefer. Huh? Great. So this means that, in fact, the mechanism is that the general partner, he wants high fees because he wants to pay. Though he goes for high volume, he wants to prove high return. He goes to have a larger volume, and that's why you have the big deals. And that's why you see now today that if you go to a venture capital fund and you say, I'm looking for 500,000 euro, they say, no, come back if you want more. We are not to analyze the whole file for 500,000 euro, because there's nothing in for us. And that's why you see you want 1 million, 2 million, 3 million, at least 5 million, because then if on 5 million you can make a carried interest of 3 or 4%, that's money. If you do that on 500,000, that's monkey business. That's why I have a tendency to go always to bigger and bigger and bigger deals, and that you see year after year that the deals, in fact, are bigger that you want to do. Now, let's quickly go to what is the life of a venture capital fund. So think about the general manager. What is he doing? He's doing three things. The first thing is he doing fundraising. Go to convince LPs. Takes normally 2 years on average. The second thing what you do is do the investments during 5 years, maximum 7 years, and then you do the divestments. You do the exits. You sell all the shares. Altogether, it takes 10 to 12 years. This is one of the big issues of venture capital today. You're thinking on short term. If you speak about sustainability and long-term investments, then we have to go to family offices. The VCs today, they're linked because the manager, he promised to his investors, to his lead investor, saying, I'm going to give you the money back after 10 years. So you cannot do an investment on long term. 10 years, you need to invest, divest, liquidate the fund, and start another fund. And that's in fact how it happens. If you look to facts and figures, for instance, you look to source of funding of Belgium, that's a study which is done by PwC, you see that amazing, 43% of all the money is coming from government funds and institutionals. In Europe, 42% of the money of venture capital funds are coming from public institutions, like European Investment Fund, like BP France, like PMV, like FPM in Belgium, you see? So, in my view, this is too much public money. We should have venture capital coming from private sources. This is the big difference between continental Europe and France, United Kingdom, and United States. United Kingdom, United States, it's private money put in VC. We are doing something like public money. So there's too much public money. And if you have public money, you have, of course, some public rules to manage as well. Great. This is the funding. So first phase, fundraising. Second phase, and this is the most important for startups and scale-ups, due diligence. What is due diligence? Due diligence for a venture capitalist is the same as risk analysis for a bank. Saying, I want to invest in a company. This company must make money for me, as big and as fast as possible. In order to do that, I have 5 criteria. These 5 criteria should be your checklist if you look for money. If you're looking for money, you should each time prove these 5 things. That's what they do. They take the checklist and say, 1, who is the manager? Do they have a track record? That's why it's very difficult for someone who has never had a track record. For a first starter, you are there, you don't tick that box. And it's very hard that will cease to invest. So the first one, what is your management capacity? That you have to show. The second one, what is the market, but especially what is the growth potential? Because we said growth potential, if you want to have a high return, you have to have a growth potential. The third one is, what is the market niche? You cannot say in a business plan, I'm going to launch just something, a new computer, and I'm going to take 5% of the market. No, that's not the market niche. What is exactly your market niche? What is your difference with everything is on the market? The fourth element, very important, liquidity, exit. When a VC steps into a company, the first thing he or she asks is, how shall I get out? What is my exit? And that is, in fact, what I see as well, for instance, the capstone projects by BMI. If people are making new projects, then the weak point is always how to get out. Who am I going to sell my shares to? Shall I try to buy them back myself? Do I think about strategic partners? Do I go to stock? Whatever. But that's something in the proposal you make to the VC. You always should have one page, how to get out. What is my possible exits? And of course, last point, technology is good, but technology doesn't sell. The market is much more important than technology. So those 5 criteria, just put them on a paper and say, let me look to my own project, let me do my own due diligence, and then you can find out of these 5 which are the weak points and the strong points. If you respect those 5, then you have a strong file towards the VC. Third phase, once the due diligence is positive, then this, okay, let's go, let's invest. Due diligence has been done. Second part is the analysis of the gap. And for instance, you have 2 engineers setting up a company. We say, yes, but who is doing the marketing? Is there an economist around? So that's in fact looking at the gap, and then they look with you and say, okay, we can do it, but you should recruit an economist. If not, we don't do it. What is the optimal structure? And one of the questions was, how many debt do we have? Well, indeed, the question will be, as a VC, can I permit to put as few money as I can and having as high leverage as I can, have as much debt financing. If the interest rate is 0 or 1 or 2, you will try to maximize the debt financing and minimize the equity financing. That's about the optimal financial structure. The valuation, which is always a difficult issue. What is the value? You start with the company, and then you're looking for 500,000. We say, okay, you get 500,000. And what do you have to agree with him or her? For the 500,000, you get a percentage. You become co-owner. How much? 5, 10, 15, 20? That's the valuation issue. And finally, you can do a stock option plan if it is needed. If you look at what happens to the fact and figures, you see on Belgium 2023, you see that the VC volume went down. So they have now 311 deals a year. That's one deal a day. That's not that much. Huh? If you look at Europe, the third column, you see that Europe, the deals decreased by 22%. So Europe decreased much more than Belgium. If you look at the value of the deals, second column, we are more or less on the same, minus 3%. In Europe, 2023, minus 38%. So the venture capital world on investment side, this was 38% less, which of course quite huge and quite important.
Can I ask a question?
Of course.
Can I ask a question regarding the valuation?
Yeah.
Are there any rules of thumb you can use as a starting company to, well, kind of define that valuation? One of the things I heard as well is that, for instance, especially Belgian funds are more, I would say, greedy and give much lower valuations, for instance, than US funds, US VCs. We tend to give it a higher valuation, so more of the percentage of the shares remain with the founders. Do you have any, rules around or things we could use?
First of all, there are some valuation methods. And if you have a course on financial analysis, then in BMI you have different courses of financial analysis. What is the value? My first element is the value is what the fool want to give for it. What is the value of a house? Well, if one says your house is worth 2 million and he pays, it's okay, So the value is a very subjective element. Now, once a company exists and you have cash flow, you have EBITDA, you have earnings, then it's quite easy because then you can say, what is my multiple? And then I agree what you are saying. I was not so long ago involved in the negotiation of an existing company. And that was, in fact, one fund that wanted to get out. And so we were in negotiation with 2 Belgian funds. The first one said, I want to give you 11.3 EBITDA. So this means you take the EBITDA, the profits of the year to make it simple, you multiply by 11, and that's the price they want to pay. The second Belgian fund says, I want to give 11.5. So discussion was between 11.5 and 11.3. And then Blackstone came and they say, I give 20. Game over. So that confirms what you say. Now, for a startup, it's very difficult because for a startup, what you're going to say is, well, startup has no value. So a startup has only value which you think it will have. So for the startup, what you're going to do, you're going to look at the business plan. And I put about the business plan. So if I take that business plan there and I see, for instance, in year 4, I have a profit of 4 million. In my example, so average profit forecasted year 4, 4 million. I will say from that moment onwards, my startup, which is now, will have 4 million profits. I should say EBITDA to make it simple. I say profits, 4 million a year. So at that moment, you're going to say, what is the value of a company that from year 4 onwards will generate 4 million cash flow a year? You see, and that's you're going to actualize. Based on that, you have methods in order to explain how it works. And that's, in fact, the basic starting point. Based on that, you will say, my company in 4 years' time will have a value of, let's say, 40 million in my case. I'll take a simple multiplier of 10, 4 million times 10, 40 million. Well, if somebody gives me, as a VC, an amount, I will calculate, based on that value, what is the percentage corresponds. But I agree with you, that the Belgian, European, they are much more eager to have more than in fact the Americans, who says, I don't care. I prefer to have 5% of a growing company than 10% of a company that doesn't grow very fast. But you are right in that. Is an answer to your question?
Yes, absolutely. Thank you.
Okay, thank you. So once the investment took place, then we still have the management of the investment. We speak about smart money. It's not about dumb money. So once the VC invested, he will not say, bye-bye, come back in 5 years' time. That's not how it works. It's not like a banker. The banker, you pay the banker back, the banker is happy. The VC wants create value. To create value, he will be there. He will say, well, what's your distribution? You're in the retail, why don't you work with Carrefour or Deleuze? He will get involved. He will deal with your marketing strategy. He will look to what do you do the right priorities. Sometimes startups, they focus on one thing and perhaps they can make more money with something else. They will have you the networks and they will give you financial advice looking to the next rounds already. So in fact, it's smart money. This means that once they are there, you don't get rid of them in the negative sense, but positively they can help you. It's not only about money, it's about coaching. And if you see then, the ultimate goal of the venture capitalist is to get out. That's what you call the exit routes. And there I have an example of the different exit routes, which you have to think at the moment of the entry. We said at the level of the due diligence, you have to think what is the exit routes. And you see the exit routes, or for instance, trade sale, or public offering, meaning you go to the stock exchange, or write-off, which is a huge exit, meaning I lose all the money, it's repayment by another fund, etc. So these are the different ways to do exit, and that's of course something you have to think in advance how to work with that. That's a bit the life of a fund, and then at the exit, of course, they will help you to see how can you do optimized fiscalization. Shall you step out as well? Shall we go together to the stock? Shall we do merger and acquisition? And that's in fact then the moment of the exit, and then you will have advice on the exit. This is in fact the life cycle of a fund. To summarize it in one example, and this is a real example. First of all, you're going to do fundraising. Then the second period is your investment periods, which normally last 5 to 7 years. Then you have reinvestment if you still have time. And then you have the exciting period of exits. You close your fund, you give your money back to the investors. And if you made a lot of money, together with your carried fund as a general manager, you start the next fund. That's why you always see in funds 1, 2, 3, like with the Kings, you have SmartFin 1, SmartFin 2, SmartFin 3, and so on. That's mostly what you do. You close the fund and you ask the same investors if you did a nice job, which would you put again in my company? This is in fact the life of a fund. I see there are no question on the chat, so I go on. And so speaking about evaluation, you refer to the evaluation concept. So we always speak about pre-money valuation, meaning the value of the company before somebody gets in. And post-money means once you have raised the financing. If you raise financing, it increases, of course, the value of your company. So raising financing is a good thing for that company. Facts and figures, if you look to Europe, you see that, in fact, an average fund is 100 million, which is good. In America, it's 170 million, to give you an example. So it's something which is quite interesting. Perhaps on the first line, the 6%, you see the 6%? The 6% is the acceptance rates. This means if you introduce a file, the chance that you get taken is 6%, which is not so high, but really, of course, you have a pre-selection because you have already the files which have been retained. So out of them, 6% get through the due diligence and get approved what you want. Interesting as well, 10 to 20%. We spoke about VCs never want to get majority. The idea of a VC is not to take over your company. It's not to take 60%. They prefer minority, 10%, 20%, because you should be the one to work. It's not up to them. They want to realize more value, but you should be the one that work for do that. That's in fact how it works. Let's forget about those figures. And you see the difficult thing of exits. You see that their exits are going down, and that's something which is quite difficult. And today, that's one of the most tricky things that a lot of venture capitals They have 5% or 10% in the company, but they don't know how to sell it because there's no secondary market. Because remember, venture capital, it's about non-quoted companies. Now, what we see, this figure is quite important because you see the difference between United States for the different phases, and that's what you see, the delta. So you see on seed, the blue one, let's take last year, we have the figures 2021. The blue one is small. This means Europe is quite close to America for starting financing. But if you look to late stage, the gap is very big and it's getting bigger. So the 195 is the difference with America. So you see the big problem we have today is on scale-up financing and not on start financing. If you took it all together, and let me focus on B2C, so the third line of my slide, if you are European at B2C, then you start with 100 companies that have seed financing, the black box. Out of them, 25 go to Series A. Series is the next round. Out of the 25, 30% goes to Series B, next round. 33% goes to Series C. And in fact, on the bottom line, 1 out of 100, 0.92 get at the end. That's in fact the funnel which I showed you in the beginning. United States, it's 2.6%. Okay, it's much more in the United States, but it's still only 2%. So it's for the happy few. So I would push you to make a very good file. And that's what you see. Most of those companies, they're all born in Europe, but they all found their money in the United States because that's where you have the money. And that's, of course, where you have the big players. And these are some examples of the deals that you've done. And you see most of them, these names are quite familiar, supposed to most of you, like Sequoia, like these are the biggest venture capital funds in the world. And they're mostly American-based, and they get the money from America with some special schemes, which perhaps one day we could explain as well. Now, if I look, what is the big problem today to find money? And now I'm going to move to the end of my intervention, closely linked to policy. The first thing is what they call the first equity gap. The first equity gap means you get money from the beginning, you get money from friends and family, you get some grants, you find a business angel, and then you're looking for something like 500,000, 1 million, 2 million. Too small for a venture capital fund, too big for a business angel. That's what they call the first equity gap. And that's why some people get not through that. Then you find money to the VC, 2 million, 3 million, okay. But then you want to expand. You need 10 million, 50 million. Or Skype, for instance, was looking for 150 million. That's what they call the scale up gap. Then you do your exit. And for the exit, of course, you need very well functioning public exchanges like Aernoudt, of course, which are in Europe quite fragmented. So these are the three challenges: the first equity gap, the scale-up gap, and the IPO, which is the third challenge. And you see, if you ask, for instance, people, what is the biggest challenge? And then you see it's one, employees for those who don't look for equity. And for those who look for equity, it's funding. For the scale-up, the biggest problem for scale-ups is in fact funding. That's why, but I will be very short on that. In Europe, we have some special measures to do that because the problem is today, or earlier we thought it was starting up. Now it's not starting up, it's scale up. Look, this is the investment scope based on 32 VCs in Belgium. 40% of them say we always go for early starts. 9% still say we go for growth. 0% goes for later stage. So now the problem, the biggest problem in countries like Belgium is to find money, not for the very beginning, but to find money where in fact you're moving. So I would say that the scale up gap today is much wider than the small equity gap. And that's in policy terms, we need to do something about it. Again, I will not go into that. In Europe, you have Invest EU, which is in fact investing now in 800 venture capital funds in Europe as a co-financing. You see that's how it works through the European Investment Fund, which is kind of fund of funds. You invest in all funds. So then, as an enterprise, you don't have direct access. You have to go as a VC fund to ask for participation. We have an alternative where we do not invest in equity, but quasi-equity. And that's an idea to attract pension funds, because then you say, we will cap the return, but in case of problems, we pay you back. So we have a kind of guarantee. This is a new system which has been launched last year. And this system has something like 20 funds. We have to have more funds on that. But again, This is for venture capital funds. This is not for companies directly. What is for companies directly is the European Innovation Council, which perhaps is not well known because you're all linked to Fintech. You must be, most of you in high tech as well. In Fintech, in fact, you have 3 phases. The pathfinder. Let me test something. The second one is transition. And the third one is the accelerator. Therefore, for the EC, it's direct funding to companies having something linked to tech or deep tech. You can have, in the first phase, just let me do the feasibility. You could have up to 3 million grants, transition 4 million, and once you are there, you can have in the accelerator, so the expansion, you could have grants, and combined we can equity of 15 million. So I would say it's worth to look at that, and this is direct into companies, and now we have again 100 million a year to invest in these companies, which happens. What are the challenges for the VC business? The first challenge, and I think it's very important to see as well, is the valuations. Somebody asked a question about valuations. Well, that's the problem. VC says everybody thinks that have invented such a smart idea, this is worth millions. It's not the case. So be careful with valuations. Second one is the competition amongst other investors. We have more and more VCs now, so they compete amongst their other. And the third one is to find the fundraising, which is a difficult issue. So what does it mean for you? I would say I will end with 7 tips and tricks. First, right evaluation. And there's something like the VC method. You take any book on financial management. They explain you the VC method. How can you calculate, based on what I said, the business plan, the value for a startup? You can take a good financial management book like mine, but there are others like that as well. Just have a look, and there you see how to do it. Second point is a realistic business plan. You have seen the discrepancy between the business plan as they introduced and the reality. So that's important to be realistic. The potential exit is key. So don't forget to say how you might exit one day. Map the competition. We see a lot of startups say, there's no competition. My thing is so unique. Well, if there's no competition, there's no market. As I said, technology is a tool, not an objective. The market is more important than technology. And then the last thing is perhaps the most important, be investment ready. Be investment ready means you should understand that at a certain moment, if a VC is on board, he or she is co-owner for 10%, 20%, whatever. He co-owns, he can decide with you together. So you must be capable to accept. And we see, for instance, in Belgium and in France, in Germany, that the question is not, is there supply of venture capital, but is there demand? And we see that a lot of companies say, no, we prefer to grow slower, but having 100% of the shares within the family instead of opening our capital. That's what we call investment ready. If you say this is a good start to open my mind, but I have not enough of it, then of course I could you warmly indicate there is a venture capital academy coming, where we speak of the venture capital, the legal framework, the valuation issues. We speak about venture capital people. We speak about business angels. And this is a venture capital academy organized by BMI. BMI, you might know, is the best graded executive MBA in Belgium, together with UC Louvain. And we have a partnership with B Angels, with Stelia is doing the legal aspects, and with the Flanders Business Angel Network. And all together, we're going to look at that. So I said, if you want to know more about venture capital, it's 4 afternoons starting in the 14th of November. So we are more than welcome. And you can see the QR code if you want to know it. That's what. If you don't have enough of what I explained, I would advise you just take one of my books. And this is the financial management one, the green one. If you want to know about valuation, that's what you should do. I will try to stop sharing now, Iona. Perhaps you can do that for me. And I'm open to any questions. I was a bit too long, I suppose, but it's 1 o'clock, so perhaps you must be hungry. But I'm open to any questions.
Rudy, Daniel Verbruggen, just a quick question. Coming back to what you said earlier, and also and thanks for the presentation, by the way, but also your concluding remarks about the big discrepancy between the business plan and the realized revenue. VCs are aware of this. So what strategy do they put against those exaggerated business plans? How do they react? They must have some schemes behind it to counter that problem.
Yeah, no, it's a very good question. In fact, what they do, they start from scratch. They put your business plan in the litter and they start again. And the first thing is, of course, turnover. What's your product? What is the market? What is feasible as turnover? And once they calculate that, they compare with the turnover that you mentioned in your business plan. You see, that's how. And then once, finally, a business plan is very easy. The turnover is key. Once you have the turnover, everything else comes from that. And the bottom line is, of course, the EBITDA. So, in fact, the first big check is this turnover realistic? And so in due diligence, the first thing is look at the turnover. And that's why, as you have seen in my slide on discrepancy, this is the whole issue. If you start a business plan that starts by saying, I'm going to launch a new diaper. The market of the diapers is so many billion. I'm going to take 5%. Doesn't make sense. You see? You should say, okay.
Yeah. But okay, I don't want to take too much time here, but what we've seen is if you are too honest and too realistic, then you get more declinations from the VC. So it's a bit of a chicken and egg situation.
You're fully right. By the way, those who are most honest are women. You see that women, the discrepancy is much lower than with men. Do you know how much of the venture capital in Europe goes to women-led companies in percentage? Somebody guess? 30% of the companies are led by women. They receive 1.5% of venture capital. This is a scandal. Huh? But, so this confirms a bit your thesis, Daniel, that in fact, VCs don't look through the business plan and they start from your business plan. So, in fact, it's not ethical, but you have interest to make that reality is nicer than it really is. And then you see by the end that, in fact, there's no link anymore between realization and what you wanted to do. And that's a difficult issue, of course.
Okay, thank you.
With pleasure. Somebody else?
Yeah. How is it easy? At which point is it easy for a startup in Europe to raise funds in the US?
It's relatively easy, and I would say especially post-COVID, because in fact what you saw pre-COVID was that we are most of the companies looking for money are digital. A digital company is very easy to move. So we saw before COVID that companies found money in Silicon Valley, they moved to Silicon Valley. Now we see in fact that companies are less eager to move because they're here, they're the family, they want to stay in Europe. And so now we have seen that most of the big funds of the United States, like the Blackstone, like Kikiara, like Sequoia, they're all based now in London. So in fact, if you want to find American venture capital funds, go to London. It's no longer officially Europe, but it's still Europe, and that's the easy thing to do. Now, what you see there, and that's going back to the question of Daniel, they do not have the same way of looking at the business plan that our VCs do. They look, first of all, at you. In Europe, they look much more at the business plan and less at the person. They come from the principle, Jean Gabriel is a nice guy. If this fails, we do something else with him. In Europe, this is not the case. In Europe, say this project will not fly, we don't need Jean Gabriel, you see? So there it's much more important that you focus and that you say, this is what I have in mind, but that they see that you're an entrepreneur. First thing. Second thing, they don't discuss too much about prices, In Europe, they say, okay, I calculated everything and I need 12%. They will say, if I have 5% or 10%, I don't care. I prefer 5% of a big growing business. You see? The inconvenience with the Americans is that normally they want to be involved in strategic decisions. And if they have a good product, but they see, for instance, and that's typical something from Professor. A professor is doing a spin-off, and he thinks he's a good entrepreneur. Most professors are not. So you start, what do the VC says? Guess, okay, you did it well, let's start. But after 6 months, you see the project is good, but the professor is not good. They just sack him and take another one. Much faster than Europeans. But you see, they have much more money. To give you an example, if I take venture capital funds who has more than 500 million to invest, 500 million. In Europe, we have 7. United States, we have 250. So yes, if you are a starter, but you should not go asking 100,000. Huh? You need at least having big amounts. You don't go with have less than 1 to 5 million. That's really the minimum, even for a starter. So they're going
for 5 million. You would go.
Yeah, for 5 million you can go already as a starter, and you even don't need a proof of concept. But you need a good idea. You need the first attempt of a business plan, but which you can value roughly, and it can go very fast. You have very fast decline, you have very fast an approval as well. In contradiction to Europeans, they never ask a non-dilution clause. You know what non-dilution means? Non-dilution, I take 10%. Even if other people come, I will stick to my 10%. They don't do that, which I find a very good thing.
Indeed.
But
thanks.
Say, just go to London. Take the train and go to London.
It's closer. Yeah, indeed.
Someone else?
Yes, I have a practical question. Are you available for tailor-made advices?
Yes,
Besides
I am.
the academy you mentioned.
But I'm not a consultant, so I don't do consultancy. You have so many consultants in the world. So if you have a question, I can help you to do it, but I will not do consultancy at that project level. My life is writing, teaching. So I'm teaching at BMI at the University of Ghent, but I don't do consultancy. But yes, if you have a concrete problem, like give me the name of some VCs which might be useful, I will like to, or you say you have an evaluation of my company, is it realistic? I will have a look with that problem.
Okay, thank you.
And of course, in the course as well at BMI, you can always see me afterwards to have a chat, but I'm open to that. But no consultancy fees. Somebody else? Okay. Then I thank you very much for your attention, because we are already more than 1 hour and you're still very attentive. So thank you very much.
I think it was very interesting. So yeah, thank you so much for this.
Yes, thank you so much.
The presentation and the recording will be available to everyone who registered for the event, and also will be shared with the rest of the members who were not able to attend the event, as well as the link for the event in November with all the details, so everyone can have access and can register for a more detailed training. So thank you, everyone. And I wish you all
the link for the academy as well, if somebody wants to know. I think that Monica managed the chats, but I don't see it now.
The link is already there in the chat.
I did add it, Rudy, for those who see the chat. So I added a link to the VC Academy where you can find more information, or feel free just reach out to us via LinkedIn or through BMI website, and we'll be happy to answer your questions and tell you more about the program where Rudy will be. There was a question before, I didn't want to jump in, about in-company sessions at BMI. We also do that. With Rudy, as well as with a number of other professors, including focused on company evaluation, but many, many other things as well. So let's connect on LinkedIn and let's have a chat if you're interested, since this is not really the topic of this webinar.
Yes, so everyone will be tagged anyway, so it will be easy for everyone who is registered for this event to connect on LinkedIn. So that will be very easy. And then also everyone will receive the link with the recording, the presentation, and also the link to the event in November.
Okay.
Thank you so much, everyone. If there is no other questions or anything else, I think we can close today's webinar. Thank you again, Rudy, for everything. It was very interesting, nice, very interesting information. Thank you for your time, and I wish you all a lovely day and a nice weekend.
Thank you. Bye.
Thank you. Bye-bye.
Bye.
Bye.